Alrighty, folks, we are back with the one and only and amazing Jason Hartman. He has promised a life-changing chart. So we're just going to welcome him to the show and see what he's got. How you doing, Jason? You've definitely not undersold this chart. What's going on?
This is one of the most important charts you will ever see in your life, in your financial life at least. So from a financial perspective, it is incredibly important.
All right, without further ado, let's bring it up and have Jason explain it to us. Oh my goodness, what the heck am I looking at?
Okay, so, look, we all know that you have to think of life, you have to think of money in inflation adjusted terms. There is a big difference between real dollars and nominal dollars. The word nominal literally means in name only. What is the name of something, right? And so you can name something in dollars, you can name it in returns on an index like the S&P 500 index, and that is the name of it. But the value of it is a very different thing sometimes, most of the times, than the name of it. And this chart shows us just that, Michael. Returns of I mean, everybody thinks they're making so much money in this wild ride we've had on the S&P, and really in a lot of news starting when we went off the gold standard, because then there was no tether anymore. Then they could pump money into the system, they could inflate the indexes, they could make it seem like we were doing much better than we really were. And so if you look at this chart, the top line shows you the S&P 500. It looks fantastic, doesn't it? Doesn't it look great? And by the way, I am outdoors, as you can tell, here at a coffee shop. So if you hear some background noise, I apologize. But it looks incredible. And people think, gosh, I don't have to do real estate. I don't have to do any management. I'll just stick my money in a Vanguard fund and stop it. Yeah, I won't think about it, right? I'll just leave it there. And you cannot do that. You cannot afford to do that, not even close, because you are being destroyed. Now, the chart doesn't show you being destroyed. It shows you making a tiny bit of money. And I'm going to address that in just a moment. But the white line at the bottom shows the real or inflation adjusted returns. The red line at the top shows the nominal returns, the name of them, in name only. So you can see here that really since 1914, the only real return on the entire S&P index has been dividends. That's it.
Interesting.
And a lot of those stocks don't pay any dividends. I don't know what percentage of the S&P 500 pays dividends, but I think a lot of them don't. And so you can see you're falling behind here. At best you're like treading water compared to inflation. But it gets worse, and we'll talk about that in a moment. I think you know where I'm going.
Yeah, I do. It's really interesting because, again, as an economist, right, somebody with that degree and has been studying the economy for 30 years, it's comical how many folks don't understand the difference between real and nominal. Right?
Yeah.
A lot of the stock folks, as this chart shows, will be quoting nominal numbers and not doing the adjustment. And
well, it's all nominal. I mean, all the numbers are quoted in nominal terms.
Yeah.
None of them are real.
Absolutely. Yeah, absolutely. So this is a very fascinating chart. I have to tell you, I had no idea it was this bad. I would not have guessed it was this bad. So well done.
Until you see it on a chart, me neither. I mean, I knew this was true, right? But it's like unbelievable, the difference. I mean, this is all just an illusion. It's a psychedelic trip at Burning Man. I don't know. It's just fake news, right? Whatever. It's just totally fake. But it's worse than this, Michael. And I think you know what I'm going to say, right? Because
I do. But
this is based on the consumer price index. Right. And the consumer price index in and of itself is fake. It understates inflation massively, at least by 50%. Or, no, it's different. Actually, I should say that slightly differently. It is at least 50% higher than the CPI or the CPI is telling us, right? So if you adjusted this for real inflation, not the fake news given to us by the CPI, this would be negative, very negative. We are
It really
falling
could be.
behind, falling behind. Yeah.
And that's really the punchline to this, right? Again, if you really step back and you understand, it's funny. I'm wearing a shirt with just by happenstance that says "Inflation's a feature, not a bug."
Yeah.
So
Oh, that's
again,
great.
this is built into our system. And if you understand, like, you don't have to like it, right? You don't have to like it, but if this is the game that we're playing, you should invest like it. And as you're showing here on the stock market, it should not be the place you put it. And,
No,
there are other
it's-
things that
yeah.
are inflation hedges, with,
Right.
Which you can leverage and safety and tenants pay off. I mean, you know what we're talking about here, but
Yeah.
all right. So what do we do with this? If we look at this and we're shocked and, we go Google it, we see that these numbers are real. What's one person to do, Jason?
The action step is you've got to get your money into an asset that really beats inflation radically. And, they've always said that real estate is a great hedge against inflation. And that's true, right? It'll go up a little bit ahead of the CPI, but it's not a
About
big deal,
1%
right?
historically.
Yeah. I mean, what's your number on that, by the way, Michael?
It's just over 1% over a 50-year period. 1% over CPI. Yeah.
CPI. Okay. So, and now we know that the CPI is understated. So if you just bought real estate with cash, you're treading water, right?
Correct.
Just like you are here in the S&P.
Mm-hmm.
But we leverage real estate, and so we amplify that return. And if you want to just turn off my screen share, I'll find another slide for you that's really telling on that. It'll take me a moment. But you outdo that return by a huge margin if you use leverage. But wait, there's more. It gets even better if you use inflation-induced debt destruction, which we've talked about, my trademark strategy there. And that inflation-induced debt destruction means that the inflation is working for you all the time to literally pay your debt off for you. It's like a free repayment of your mortgage.
Yeah. One of the things that we don't appreciate enough in America and the US is our 30-year debt structure.
Yeah.
Right. The fact that you can choose to lock in debt and have it fixed for 30 years is truly a gift.
It is. Yeah. It's like I like to say it's like a welfare program for real estate investors.
Yeah, it is. It is. It really is.
It's like a free welfare program. I think I'm coming up on this other chart if I can find it. If not, I'll share it when we get together in 2 weeks. I know you're out next week. Maybe you want to tell your listeners about that.
Yeah, Jason, or I'll be out Monday in Orlando, folks, speaking at an amazing event. So if you're out there, come see me. But I'll put that in the link below.
Yeah, good stuff. Good stuff.
While you look for this, you found it?
Oh, no, didn't yet. Sorry.
Okay. Yeah. What I was going to say is one of the things that I was looking at over the weekend is I think the fall housing market, which just started September 1st, I think it's going to shock people in how strong it is, right? We just saw the largest drop in mortgage rates in quite a while, 16 basis points. The 10-year is down again today, which means mortgage rates will be down. I'm getting more and more people getting quoted in the 5s.
Yeah.
And,
I
think
that's with a little bit of a buy down, right?
Sure. Yeah, absolutely. Yeah. It's definitely with the buy down. But again, today you can get sellers to pay for the buy down. But what I'm saying is I think the fall housing market's going to be stronger than people expect because I think people are going to start coming off the sidelines. What do you think on that?
Oh, I think you're absolutely right. I mean, we know that there is a lot of pent-up demand, a lot of shadow demand, a lot of people to the tune of maybe up to 2 million per year for the last 3 years that have been waiting. They've been putting off their decisions because of the high rates and the high prices. So, you either need rates to come down or prices to come down. And it's hard for prices to come down when you have the lock-in effect and nobody is really that motivated to sell because they're very comfortable and you have a shortage of supply. So rates come down and the market just is going to light on fire again. We've talked about, and you've seen my chart on that, a 0.5 point reduction means an additional 2.7 million people who can qualify for the median price home. You get a 1% reduction. I don't remember the exact number.
It was 11 million.
Well, yeah, that's a 1.5%. 11 million people at 1.5%. Wow. So think about that. In a market where we've got only just over 800,000 homes for sale in the country, that is just going to be a bidding wars, multiple offers. It's going to be crazy. And by the way, Michael, I do have that chart now if you want to share
There
the
we go.
screen again.
Yep.
Yeah,
there
here it is. So, if we assume that real estate appreciates only an average of about 6% annually, right? That's not going to do that much for us because inflation is going to eat into that return. And, there are varying opinions on what the appreciation rate is. It depends what study you watch. It depends what period you do, yada, yada, yada. Okay. And there are varying opinions on what the real rate of inflation is. Okay, fine. We all know that. But let's just take an example here. If we pay cash and we've got $1 million portfolio, say that's 3 or 4 houses that are good rental properties, we're going to get $60,000 per year in appreciation return. That's only one dimension of this beautiful multi-dimensional asset class. And if inflation eats that away, it's going to eat up half of that, right? According to like CPI. So we're only going to net 3%. We're only outdoing inflation in this example by 3%. But if we leverage it with 20% down, we've now got the multiplier effect of that leverage, and we're outrunning inflation by 27%. Okay,
Yeah,
this is
exactly.
like this alone, and most of us understand the value of leverage. Okay, and that's great. And the leverage would be expensive if we had to pay for it, but the tenant pays for it, not us. So it's free leverage, right? And that 30-year fixed rate loan that is unique in the U.S. Compared to all the rest of the world is the welfare program for real estate investors.
And again, and the other beautiful thing about the 30 years, it's a one-way bet. If rates go up, you just stand pat. But if rates go down, you can do a rate and term, you can do a cash out, you can do all of these other amazing things. So again, I think we are just about to see a surprisingly strong fall market. I think mortgage brokers are about to get swamped with people doing
they're going to
rate
get
and
a
term
lot of
refis.
refi business. Yeah.
Oh, it's coming, man. It's wild. Do you think we could see sub 6% by the end of the year? Do you think? Because today, just so for comparison, we were 6.29 on Friday.
Yeah, I got to tell you, I am terrible at predicting interest rates.
Yes, as am I, but I'll ask you anyway.
I'm good at predicting other things, but interest rates, because they're, Michael, look, if interest rates were market driven, they're not. They're centrally planned, right? But if they were market driven, you and I would be pretty good at predicting them because, we can look at the market and how a market is acting, but when you put the central planners in there, you get all sorts of distortion. Or what mood Powell's going to be in, how much he's going to wake up hating Trump that day and trying to kill his party. So I don't know, but they're definitely coming down. I mean, I think we all know they're coming down. Even Powell says they're coming down. Okay, now finally, and the market says they're coming down. So sub 6% by the end of the year. That's maybe a little optimistic, but I don't know.
Okay. All right. So no, I like it. I like that answer. I guess the last thing I wanted to ask you about is we've obviously heard from Scott Bessent and President Trump that they are on the cusp of declaring an housing emergency. Any idea what that thing might be?
I have read about it. I have studied that, but I don't know what it really means. I assume it means the government will have some sort of emergency powers. And I want to think, Michael, although I don't know, I want to think that those emergency powers would be related to the relationship between the central bank or and give them maybe more power over the Fed, because the Fed is arguably this independent entity, right? Or it would give them power to circumvent the Fed. And the government can do that, by the way. The Treasury can circumvent the Fed. I interviewed Richard Duncan on my show a while back when I was in Thailand. I interviewed him in person that time because he lives in Bangkok. And he's been on my show many times. If you haven't interviewed him, get him on your show. He's a really interesting economist, very smart guy. And he outlined the way the Fed, or the way the government and the way Trump can go around the Fed and do all sorts of things. They're really interesting. They can totally do it. It's very feasible. And he outlined the way they do that. And, I wouldn't be doing it justice if I tried to explain it.
So really what I hear you saying is where they're likely to go is after the interest rate or down payment. So basically demand driven.
Yeah, no. I mean, I think it would be a multi-tiered emergency powers. They'd probably have interest rates, maybe selling the federal lands to developers, maybe having some bigger control over like local zoning laws. But the cities in general seem to be getting pretty understanding of the fact that they need to lighten up on the zoning a bit, right?
Yeah.
Because they've been way too strict about that over the years, over decades.
For sure. Yeah. Well, very, very cool. So it's never boring.
Do you have an opinion about that? Like, what does an emergency do? What could they?
Well, again, so when I think about this, it's either supply or demand. What should they do? They should target supply. Unfortunately, the federal government only has carrots because again, it's all very local. So they could create 100 billion, a trillion, whatever they want, and say, hey, if you do what we want, we're going to give you some money.
Right.
Unfortunately, in my opinion, that is too slow and not splashy, not headline grabbing. And frankly, the thing that Trump is the worst at, right? Politics. He's terrible at it and doesn't pretend to be a politician.
Yeah.
So what I think they're going to do is they're going to go after. I'm not saying it's bad. I'm just saying it's not him, right? The slow bureaucratic carrot, it's not happening. So he's just going to go after demand, and he's going to go. I mean, they could do lots of things. They could bring back Obama's $8,000 version tax credit to buy a home, right? They could do that. It wouldn't be $8,000 this time. It'd probably be 15
prices go up, though. That's
that's what I'm saying. It's all demand. Again, I agree. Again, what should they do? Supply. What will they do? Demand. Because it's splashy.
You're probably right.
I could throw out 20,000. You've always wanted a home. You can't save money. Let the federal government give you $20,000 back on your taxes. Easy.
Yeah.
So demand. That's what I think they're going to do.
Yeah.
And we get what we get after that.
And that'll be if for example, if there was an $8,000 credit for first-time buyers, every low-end home would just instantly go up by $8,000.
It'd be more than that. It's leverage.
They will raise their price and respond, right?
Yeah. It won't be $8,000, Jason. You just showed us. It'll be like $50,000 because it's leverage.
Multiplier effect.
Exactly, a multiplier effect. Looks like we got a bunch of sound outside. We covered so much today, Jason. Where can people find you?
JasonHartman.com. Oh, and there's the train.
There's a train. You can find him at JasonHartman.com. Jason, you're amazing. Thanks for doing this.